major Chinese lender Ping An Bank has reportedly put 41 firms on a list of developers eligible for its funding support. Now, this is the latest move in Beijing's protracted venture to rescue its beleaguered property sector as an unprecedented housing slump worsens. And this comes just a day before China is scheduled to announce key property data. CNA's Elizabeth Neo has more.
Well, the final set of 2023 data for China's beleaguered property sector will be announced tomorrow. The numbers are likely to confirm what's been another tough year for its developers. What's less clear, though, is the path ahead, given the limited success of the government's restorative efforts so far. The first real sign of government-level concern about the sector's mountain of debt came in 2020, when it imposed a so-called 3 red lines. The new regulations acted as brakes on the industry, forcing companies to improve their liability ratios. And then Beijing's attempts to cool the housing market brought more pain as credit was squeezed and cash dried up, with limits on mortgage lending and rent caps aimed at reducing speculation. Plunging sales also turned off the cash cow of down payments from apartments sold off the plan. For years, developers used those funds to purchase land for new projects rather than building the homes the buyers paid for, a practice that some liken to a Ponzi scheme. It also ratchets up developers' debt. When credit dried up, home buyers are left stranded with no property to claim. Given that the sector contributes up to a quarter of the country's GDP, analysts estimate it could take anywhere from 6 years to more than a decade to fix. With China's economy sputtering and confidence in the property still weak, home buying interest is unlikely to pick up. This means developers' cash crunch could continue despite official stimulus. The consensus in a recent survey of 10 investment banks, such as Goldman Sachs and Morgan Stanley, is that Beijing's efforts to shore up growth aren't enough. If they're right, property construction could shrink for a 3rd straight year in 2024, a record streak. With the cash crunch set to continue, how many more developers could run into trouble? A Singapore-based artificial intelligence firm, Transparently.ai, helped CNA crunch those numbers. The company uses AI algorithms to detect red flags, such as signs of balance sheet manipulation. After running them through more than 200 listed Chinese developers, here's what it found. Of the 18 large-cap names, 7 have a 50% chance of running into trouble. These refer to firms with a market value of $3 billion each. And if 7 of them collapse, the potential loss in equity value could be nearly $40 billion. Cascading down to the 100-plus mid-cap firms, those worth between $250 million and $3 billion each, 65% are likely to go under. In actual numbers, that is 68 of them. And for those valued at below $250 million, 3/4 of them have a 50% likelihood of collapsing. That is 73 firms. Basically, these numbers mean the total equity value at risk may exceed $110 billion. That is the amount which could be wiped off these companies' combined market value. And the value of debt at risk, a multiple of that.
And for more analysis, let's bring in Hong Hao. He is Chief Economist at Grow Investment Group. Mr. Hong, thank you for joining us on CNA. Do you think many listed developers could face funding challenges?
Yeah, thanks for having me. It seems the way it's likely to happen. In the sense that last year, property sales was down substantially once again. So property as the property sales is down, the developers are finding it very difficult to recycle their cash. So that gives a vicious cycle. So the property investment is down, inventory level is way up, and also the existing inventory and the secondary housing listing suggests that a very substantial inventory pressure in the market. So I think as a result, I wouldn't be surprised to see further funding crunch for many of the developers.
Just how bad do you think that China's property crisis could get? What's your worst case, best case scenario?
Well, obviously the sector is not responding to policy initiatives, right? So, in last year we have cutting mortgage rates, cutting down payment, removing all the purchase restrictions and all that. But I think even as we're speaking now, as the situation getting more and more dire, many of the lower tier cities are still having some sort of purchasing restriction in place that further limit the already weakened demand. So I think as a result, you're probably going to see further bad news coming. So the worst case scenario, obviously, just now, your colleague mentioned a report that is done through AI number crunching. But if you're on the ground, you can see that there's a ripple effect that is going on, right? So the leading firms are having a very difficult time selling their projects, and just imagine the smaller firms. So I think as a result, property sales is down 1/3, 1/5 to 1/3 last year. It probably will decline further from here, because you can't settle at a general equilibrium. You're probably going to settle at a suboptimal point. So I think as a result, it's very challenging right now. So worst case scenario is takes 8 to 10 years to clear out the inventory. The best case is about 4 to 5 years.
So you've got your ears to the ground on the property market in China. You've said previously that China's property problem could take a decade to solve at least. So you haven't actually changed your assessment.
No, because I mean you can figure out the number very quickly, right? So there are 10% remaining urbanization process to go. So 10% of the population, then you quickly figure out how much new living space you will be requiring for the next 10 years. Then you figure out how much area is under construction. It's about 6 billion square meters of residential residential buildings under construction. So each year, you probably take 1/10 of those inventory, to the newly urbanized citizens. So as a result, it takes up to 10 years to clear all the inventory. And by the way, we're still building, right? So we're still building, and also there's a huge inventory of secondary listings in the market as well. So for example, in the last month, the secondary listing in Shenzhen is up close to 100%. In Shenzhen, which is the major tier 1 cities. I mean, just imagine, the lower tier cities. So one shouldn't be too surprised by, such sort of, outlandish projection, because overall the situation, the inventory overhang situation is very substantial.
Are there any grounds for optimism? I mean, we've had reports saying that home sales, Beijing, Shanghai, rebounded after the government cut mortgage limits. What's your forecast for tomorrow's numbers?
Yeah, I think in December we had a brief moment of rejoice. But then in the first week of January, sales is down 45%. So, the rebound doesn't seem to be sustainable. And also, keep in mind that when you look at the property transaction data in China, there's a lot of, air in it. And in the sense that, people can sign a contract online, but then they forfeit the contract later on, et cetera, et cetera. All right, so, even though there are signs of life in December, it's clearly not sustainable. And going into January, we're down 45% again. So I think we have to be very patient. I think back then, because the government was able to stimulate the property sector, with all sorts of stimulating policy, and the sector seemed to be very responsive. But this time it's different, because the household leverage is way up. It's about 300 to 350% of GDP. Right? So the room for further leveraging up the balance sheet is very limited. So I think as a result, the sector is not as responsive to the government policy initiative, and it takes a long time to fix it.
Hong Hao, thank you very much for your analysis. That was Hong Hao, Chief Economist at Grow Investment Group in Shanghai.